Hey, everybody. Thanks for tuning in. Remember, if you like information about real estate, please like and subscribe to my channel. I'm Josh Brenner, that's living in Westlake Village. I'm here today with my trusted lender, Brian Farwell, and he's with Cross Country Mortgage right here in Westlake Village. He handles all of my personal loans. I recommend him to all of my buyers. He's honest, he's upfront, and really important to me is he responds to me right away whenever I call him, text him, or email him. He's always got a response, and if he doesn't know the answer, he finds it out and he gets back to me with a quickness. So we're going to talk today about the interest rates and what's going on in the market. And I have a few questions for Brian. Brian, how you doing today?
I'm good. Sometimes I regret that I gave you the secret phone number to the bat line, but I'm always here to answer your calls and help you and your buyers through the escrow.
You don't know how much that means to me and how much I appreciate the ability to call you at 1:30 in the morning on a Tuesday and ask you about what's going on with my buyer's loan.
Absolutely.
All right. So first question I've got is, or actually just, can you explain to us about the Fed meeting that happened the other day and what's going on in the loan market?
Yeah, for sure. So this week, if you saw headlines or kind of leading up to Wednesday, the Fed had their March meeting Tuesday and Wednesday. They ended Wednesday around 11 a.m. Our time. And afterwards, they sort of came out with their results of the meeting. So going into the meeting, about the 2 weeks leading up to the meeting, we saw the market kind of incrementally stepping up in interest rates every day because people knew that we were going to get our first rate hike in over 3 years out of this meeting. We weren't 100% sure how much that would be. There were some ideas. So it was between 25 and 50 basis points, and they ended up deciding to hike rates 25 basis points. So on the low end of what we were projecting. So that was good news. However, there were two things that they sort of talked about in the post-meeting press conference, if you will. And the first is they did mention an expectation or a goal of 6 rate hikes throughout this year. Now that is higher than what they were talking about a couple months ago when they were saying 3 to 4. It's anyone's guess whether they'll actually follow through with those. I think a lot will depend each meeting on the data they get to see what's happening with inflation and how the market's responding to each rate hike. And they can always pivot. No one holds them to this. There's no guarantee they'll follow through with 6. But as they look at the data of what's ahead for the rest of the year, that is what they're currently projecting. So that was interesting, and the market responded accordingly once that news kind of came out.
That's awesome. So do you think rates rising will have an effect on home prices?
Yeah, man, no pun intended, but that is the $1 million question people are asking.
Right.
Are we going to see prices settle down a bit with rates going up? Because, the fact of the matter is rates are going up. They have been going up since the new year specifically. And yet the big issue that I've been talking to so many of my clients about is not the interest rates. It's the supply and demand. And that supply and demand issue is not going away, in my opinion, anytime soon. I don't have a crystal ball, but I think I've talked to some people in the industry. I've heard videos and podcasts and things like that. People are talking this could be a 12, 24-month supply and demand issue before we even get somewhat ahead of it.
There are some agents in my office that are, up in the years in the business that believe this market could continue upwards until 2030, believe it or not.
Wow, exactly. So the supply and demand issue, especially in Southern California, in our area where we aren't seeing a lot of new builds, a lot of expansion, we sort of have inventory. There's a little bit of new inventory coming on. And what's really interesting, Josh, I was having this conversation with you actually last week and a couple other agents, and that is we have this supply and demand issue, which there's a lot of factors in it, right? Delays in goods to then build the new homes, space, things like that. But one of the really interesting things, and we'll get to it a little bit later, but so many buyers are having to be non-contingent when they buy a home, meaning they keep a home and they're not putting it on the market. So what's happening is they're keeping a home either because they can't sell it, because they won't get their offer accepted, or because they have a crazy low interest rate and they want to rent it out. And so they're actually taking a home off the market without putting one back on. And so we're just cycling to where this supply and demand issue is not getting any better until people start offloading properties before taking one or buying a new property on the market. And so because of that, I don't really see interest rates going up as having a massive effect on kind of the current market and some of the struggles that buyers are having with getting their offer accepted.
Yeah, I agree. I agree with that. And in the last couple of years, when I've seen interest rates rise, in my experience, I've seen all the buyers start to come out. It's funny because you would think when the buyers see the market or the interest rates at the extreme low that they would be coming out, but it's kind of that fear of missing out thing. It's not until the rates start really jumping and then all of a sudden all the buyers start coming out, and now we've got a fast moving market and then prices keep increasing.
It's funny, Josh, we just had a 2-week stretch, like I said, with pretty much every day from March 1st till the 16th, that Wednesday of this week, of rates rising. And yet this week I opened more purchase escrows than I have any week so far in the last 6 months. We opened 6 new escrows in the last 4 days of purchases, people getting into escrow. And so some of it may be the fear. Listen, we've had a volatile couple of weeks. Rates are going up. We're now sitting in that mid 4.5, 4.75.
Still not bad. Still an
it's not
attractive
bad.
rate.
I've even seen a 5 pop up here and there, depending on someone's FICO score. And so as they're rising, I think there's buyers saying, okay, let's go. Let's make our strongest offer now. Let's not, put only one foot in front. Let's put both in, go all in on the most aggressive, strongest offer we can write in order to get something accepted.
That's my strategy. So what are some of the biggest hurdles that you see the buyers encountering right now from your perspective?
Yeah, it's a lot. I've joked when I've talked with buyers, I feel like I'm 50% mortgage lender, 50% therapist in the new year, just because it's such a challenging market for buyers. There's really 4 hurdles that jump out to me right away. The first is just being able to either reduce significantly or remove altogether your appraisal and your loan contingency. So that seems to be a big one. Now, the caveat, of course, is this isn't for everyone. There's certain qualifications you need to meet. You need to be strong. You need to know your options, in my opinion, and know, okay, if option A doesn't work, what is option B, so that I don't lose a deposit or something like that. But the way we're really countering that is something we call fast track approval, where we're getting our clients in, and Josh, you're great at this. We're talking to your clients right away before they're even looking at homes, and we're doing everything. We're not just taking a verbal application. We're having them fill out all their details. We're checking credit, checking pay stubs, W-2s, their assets. We're even having an underwriter look at everything so that we're so confident in the offer that we can tell them they can remove their contingencies. And so that's really how we're kind of counteracting that one hurdle. Another hurdle that kind of goes hand in hand with that is appraisals coming in low. Because almost every house is going for above listing, the appraisers who look at data of closed homes can't really keep up with the latest price. And so we don't want our clients to get blindsided in escrow when an appraisal comes in low. So we're really putting together numbers, video presentations for them early on to say, hey, you're putting 20% down, but if this under appraises by 10 grand, 50 grand, 100 grand, here's what your options will look like. Let's know what those are so that we're prepared for what could come. We're not trying to scare them, but we are trying to educate them ahead of time.
Yeah, that's really great information. From the job that I have to do right now with the market conditions, it's essential that I'm able to bring my clients to you and have what I call this formal underwriting done.
Yep.
So that when I write my offer, I'm able to write these shorter escrows. So I'm more competitive against these other buyers because sellers will get their money much sooner. And every seller would love to have money now versus money in 30 or 45 or 60 days.
Yeah.
So it really helps.
That's been big. I do want to, sorry, what were you going to say?
No, I was going to say that it really helps me. And then that other part of what you were just talking about, where you actually set the expectation of, hey, listen, you are going to overpay for this house right now. And there is a possibility that the appraisal won't come in. So we got to verify that you're willing and have the money in the bank to come out of pocket if need be.
Yeah. Appraisals are such an interesting thing. One of the comments or one of the conversations I have with buyers when they say, well, what if it comes in low? Am I overpaying for it? What's the house really worth? It's interesting. It's maybe worth a little bit less when you're in escrow, but the second you close, your house is now worth what you paid for it, because that's what the market will give. So you're not really underpaying. You're just paying for a higher number than what an appraiser who looks mostly no emotion, but at square footage, bedroom count, things like that, is valuing the property. But frankly, in a market like this, emotion and demand does play in to the true value of a home. And that's tough to put on an appraisal. So
yeah, that's also, I was just talking to one of my clients yesterday, and I was trying to help and advise her as to where we had received a seller multiple counter offer.
Yeah.
And I was trying to explain to her, because I don't think she had her heart set on this particular house, but it's okay. But in this market, if you pay, let's say you pay 100 or 150,000 over asking, and you close and the appraisal didn't come in and you feel like you overpaid, well, guess what the next house in that neighborhood is going to come out for sale for? It's going to come out for sale for most likely at least what you just paid.
Yep.
And then it's going to sell for more. So in essence, you're not overpaying because of the market conditions. And we're just seeing these dramatic increases. So
the only main reason to be concerned, I think, with an appraised value, in my opinion, is if you're trying to flip it quickly. But if there's a plan to hold it at all, then, as you said, more inventory is going to come on and set the new price and the new price and the new price, and you're no longer going to be, right, below value, so to speak. So
I agree.
Those are some of our biggest things. The last thing I'll mention, just in terms of a hurdle, it kind of goes with a contingency, but it's the idea of being non-contingent if you own a home on selling that home in order to buy your next one, which there are some people that income-wise and asset-wise have enough liquidity to have enough for a down payment and enough income to carry both mortgages. But there's some people that don't, and that need the equity in their current home in order to buy their new home. And so we have a product we can talk about a little bit more, but it's a bridge loan that we rolled out. It's an awesome bridge loan. It's a relatively low rate at 5.99, which is low for a bridge loan, 4-month loan. And we basically get you assets or equity out of your current home without selling it in order to buy your new purchase non-contingent. And so once again, there's a lot of thinking outside the box that lenders are having to do right now to partner with our buyers and our real estate agents in order to get offers accepted. It's no longer, here's a pre-approval, 30-day close, an appraisal, loan contingency, and let's see if we get it offered. Frankly, if a lender's doing that, they're not really giving the best service and advice to their buyers. We got to think outside the box right now. It's a really challenging market. And so expert real estate agents like you who know the area, knows tricks and ways to help an offer stand out, lenders who have experience in the local market, those are really valuable resources.
I agree. So Brian, where do you think rates are headed?
Oh man, well, if I knew for sure, I always say this, I'd probably go to Vegas right now.
Well, what do you think? Based on your experience, and
for sure.
I know we're in uncharted territory right now.
I mean, here's where we're sitting. Right now, we're sitting mid to high fours. Like I said, 4.5, 4.75, 4.99, something like that. I don't think it's out of the realm of possibility to have rates consistently at the 5% range. I don't think that's forever and long term, but I think right now the inflation is so out of control that the rates going up slightly more, if the Fed believes that will settle down the inflation, that's going to be something that is sort of a sacrifice that I think the market is willing to make in order to settle inflation a bit. Much above 5, I do think you're going to start spooking the market, and that will be bad. That will have negative ramifications. And so there's that fine line. I'm glad I'm not part of the Fed, because I don't know. You can't suddenly move rates up to 7% when a year ago they were at 3%. That would not be a good thing for buyers, and it would have really negative ramifications. So there's that fine line. But I think we're near the top of the curve. Like I said, maybe another quarter or so we could go for a time. And then the goal would be, once inflation settles a bit and maybe, life continues to go back to normal, what we knew, 2+ years ago, we may see those rates starting to cycle back down, hopefully not back down to 2.5, because frankly, that was only there because we were in the middle of a global pandemic, but getting back down into the low 4s and high 3s would be nice to kind of see that settle in that space.
Cool. And then last question I'm going to ask you is, what kind of loan programs are you offering? Are there, besides the conventional 20% down or more kind of loans, what kind of stuff do you got going on?
Man, people don't realize there are like hundreds of different types of loans out there that you can do. So of course you got your vanilla conventional 20% down. Even within that though, you have a conventional 5% down, right? You have your FHA and your VA. So those are still what I would consider pretty vanilla. And we do those all the time. We serve veterans that qualify for VA loans. It's a great product, low rates, possibly zero down, and all of that. But even going a little bit wider, I mentioned the bridge loan, which is like a secondary loan that we started offering recently to help people buy a new home. That's a great product. Recently, I've done a fair amount of bank statement loans and asset depletion loans that are really, really valuable for self-employed borrowers. So here's basically how those work. On a bank statement loan, self-employed borrower, let's say they're writing a bunch off, they have a lot of expenses. One of the beauties of being self-employed under the tax code is you can write a lot off and avoid paying the IRS a bunch of taxes. And it's great. Take advantage of that if you can do it. And you're self-employed and your CPA advises you and everything. But the fact of the matter is, if you're doing that, a lender is not going to use your traditional tax returns to give you the maximum income that you actually qualify for. And so a bank statement loan allows us to take 12 months of bank statements. We literally just look at all 12 months. We add up all the deposits, take out any random things like a fantasy football payout or, some Venmo thing that comes in. We take all the business income, invoices, deposits, and we simply divide that over 12 months and then we divide that in half. And that's the income that you get. And so I have had borrowers that don't qualify for a traditional loan that we suddenly go into a bank statement program and we now give them $50,000 a month of qualifying income because of the deposits. So it's a great product. You can put 10% down, as low as 10% down.
Wow.
The rate is maybe 1%, 1.25% higher than your conventional. But remember, how much are you saving on the taxes?
For them, it's worth it. Yeah.
The trade-off, it's absolutely worth it. And the asset depletion loan is very similar. Instead of doing bank statements, we'll just take a total portfolio, let's say a $5 million portfolio, and we have some calculations we do based on what type of portfolio it is and all that stuff, how old you are, and we can basically give you income based off of that. So those are great loan products we're doing a lot of, specifically designed for self-employed borrowers. And then there's one more that's really neat. This is for your investors. Josh, I know you work with a handful of investors that buy properties. And this thing is like the hot loan in the mortgage world right now. It's called a DSCR loan, a debt service coverage ratio loan, DSCR. And the idea here is I don't need to see any income from the borrower. All I need to see is that the rental income will be equal to or greater than the mortgage payment. That's it. So there's a down payment, depending on FICO scores and things like that, whether it's 25, 30, 35% down, depending on what it is. And we literally just look at the mortgage with the rate, the taxes, possible HOA, and then what you're going to rent it for. And as long as the rent is equal to or greater, we'll give you a loan. And so it's pretty phenomenal for people that are self-employed, writing a ton off, don't want to look at their income, but want to invest in real estate through rentals. It's a great product.
Wow. What's the interest rate on a loan like that?
Those are going to be similar, maybe even a little bit higher, but similar to the bank statement loan. So you're probably looking, if the going rate today is at 4.75 on a conventional, you're probably touching the high fives. And then what matters there, and this is where there's a sliding scale, is you may have 1 to 2 points associated with that, depending on what you choose. There's different options that we'll be able to present to you.
Right. And so for more novice buyers, what does that 1 to 2 points mean?
Great question.
In terms of like dollar amount, is that an upfront fee that they have to pay?
So points in lender terms, 1 point is simply 1% of whatever your loan amount is. So 2 points is 2%. So you may be buying a home for $1 million, but putting, let's say, 30% down, which means you have a $700,000 loan. So 1 point on a $700,000 loan is $7,000. And what happens there is it's just added to the closing costs due at the time of closing. Points come into play mostly on products that carry a little bit of risk. So it's a way for a lender to sort of hedge their risk up front by collecting a little bit of a higher upfront fee in the closing cost because the loan is riskier. So that's kind of how points work, high level.
Cool. Well, Brian, this has been a lot of great information from you. I really thank you for joining me today. All my viewers out there, if you guys are thinking about buying, get in touch with me and I will help you get in touch with Brian. And
Perfect.
That is the first step in getting you your house, is we have to get you formally underwritten and pre-approved with Brian Farwell right here in Westlake Village. He's going to get you the best rate. He's going to get you the best loan program that he can get for you. He's going to give you the best service. I guarantee that because I use him myself. So thank you so much, Brian, for joining us today. Thank you, everybody. Remember, please like and subscribe to my channel. This is Josh Brenner in Westlake Village. Thanks so much, guys. Get some exercise today, and I'll see you guys next time. Have a good one. Bye-bye.